Hello, hello. Welcome in. How is everyone? Well, I guess you can't answer me, but I hope everyone is doing well. We were just laughing. We were chatting behind the scenes, talking about real estate and design and mortgages, and we were having too much fun that we forgot to start the slides. So sorry, we're tuning in 30 seconds late. But anyways, we usually like to give a good minute or two to get everyone settled and in. I know it's 7 o'clock at night. You probably are trying to feed kids, put kids to bed, do work, eat your dinner. So we appreciate you joining us. You know, we did this last year at lunchtime. We tried a new program at lunch, and I just feel like we didn't have as many interested parties. So we wanted to try evening again. So let us know if you like evening or not. Okay, we're getting more and more come in. So I will get started. My name is Julie Busby. I'm the founder of Busby Group. We are a top 1% real estate team in Chicago. Why is that even important? Well, really because we have excellent relationships, including with the two that we have here tonight, as well as we have amazing resources. And webinars like this are one of the resources that we love to provide our clients. We meet our clients where they are. Let us know what you'd like to hear about, and we can do a webinar around it. So just let us know. Tonight's webinar is about the marketplace, what we saw last year, what we're expecting, and some fun design trends. So I wanted to introduce my partners here tonight. I've got Mike V. We've worked together for many years, and he's helped many clients of ours, including my own personal loan. He is a mortgage broker at A&N Mortgage. They have also amazing resources. So Mike, thank you for coming.
Thanks, Julie. It's a pleasure and honor to be here with you and Marcy once again.
Yes, we are excited. And then Marcy, the true hit of the show, is our designer extraordinaire. We've worked together for 13 years. She was the in-house designer at Belgravia Group, which is a top developer in Chicago, where I was lucky to manage sales. We've been friends and colleagues ever since. I think we've helped a lot of clients together get a lot of equity and help people sell.
Well, and we've been each other's clients too.
And we've been each other's clients too. So there you go. So anyways, you guys are in good hands tonight as we talk about the marketplace. So I will jump in. A fun fact of Webinar Geek is that when I share my screen, I do not get to see the presentation screen. So bear with me. If you cannot see what I'm sharing, please let me know, especially Marcy and Mike. Let me know if you guys can see. Can you?
Yes, we're good.
So far, so good.
Okay, perfect. So I mentioned resources at Busby Group. One of our resources is our behind the scenes market data that you have access to. Actually, let me click back so you can see where this is. This is our website, busbygroup.com and /market data. This will have different neighborhoods in the city as well as suburbs and other general marketplaces. So please come take a look at this. This is live data fed from the MLS. So tonight, what we like to do is we talk about what happened last year and what we're expecting this year. Inventory is a topic I like to talk about. It's a newer topic that drives the marketplace. It used to be jobs and rates drove the marketplace, but inventory has been a hot topic ever since COVID. We've had either very low inventory or we had a 3-year period of a decrease in inventory in Chicago. So I want to show what we recently experienced. You see the low decrease in inventory, and I have exciting news to share that in 2025 last year, we had a 3% increase in inventory. So that was good news to our marketplace to make it a more even marketplace. We're still not where we need to be, but it's good to see inventory for buyers. So buyers know that, hey, we're hoping to have more inventory, and sellers know that inventory is coming as well. And I'll get into that in a second. Multi-units. And let me point out on our website, so this is inventory. This is all of Chicagoland. We're going over Chicagoland because we want to talk about Chicagoland as a whole, which includes the suburbs and the city, and includes attached and detached condos and single family homes. And then I also like to talk about multi-units because we have a lot of clients buying investment properties, and we like to talk about that. So you'll see Multi-units are kind of following suit. They've also had a decrease in inventory, and we had an increase last year. They increased 5.35% in inventory. So that's good news that we have inventory. And this next year, we expect inventory to increase again. We actually expect it to follow suit and have about 3% increase in inventory in 2026. Also, when we talk about inventory, we should talk about number of sales, because number of sales have been a big topic as well. This time last year, I was coming to you letting you know that 2024 was a 30-year record of the lowest number of sales. That was a rough year. But I will tell you, we did have an increase in number of sales. We had 0.6% increase in number of sales last year in Chicago, which honestly, I'll take it. And again, it did help the marketplace, and we'll talk about where the marketplace is now. But what we're expecting for next year, or this year, 2026, we are expecting a 3% increase in inventory, both in attached, detached, and multifamilies. And then also we're expecting a 1 to 2% increase in number of sales. So a busier marketplace this year, which we are already seeing. And on that note, we are already seeing a very busy marketplace, and we have not seen the increase in inventory yet. And we are already seeing demand. So I'm just dropping that little hint for sellers there that inventory is still low and demand is very high right now. And we are expecting to have more sales this year, 1 to 2% more. Okay, average market time. I like to look at this as well. Again, this is average. And I want to stop here to talk about this, is why it's important to look at your micro markets and not also the broader picture. And I'll say that because a lot of times people look at national data and hear everything's terrible. But honestly, in Chicago, we'll get to it, we actually had a very good year last year. So don't just look at the big data, also look at micro markets. So I'm going to hone in for a second here on average market time, because you will see from 2025 to today, we've had an increase in average market time. The market time on average is 47 days, and it went up from 44. And I'm sure you're sitting there thinking, in my neighborhood, things are selling very quickly. So I like to point out a few micro markets. I'll do a call out. Gold Coast, their market time is 96 days. Now, keep in mind, this is average for attached and detached, so not just condos or single family homes. So Gold Coast had 96 days. Believe it or not, that was a decrease. They did not have an increase. There was a decrease in market time. They were in 100 days of market time this time last year. Lincoln Park was 56 days, with condos being 36. I'm sorry. Yeah, 36 days for condos, 56 for the average. Payless Park, 37 days. Wilmette, 29 days. So you do see the burbs are selling at a much quicker rate than in the city, but the city is also, depending on your target marketplace and your micro markets, things are still selling very fast. So don't necessarily look at the macro. Make sure you look at the micro, where you are going to sell and where you're going to buy, to know how quickly things are selling. If you don't want long market time, obviously there are strategies to reduce market time. Presentation is a big one, which Marcy can help out with. Pricing, and we can get into that later. But market time did increase this last year. Multi-units market time decreased. Actually, but what's interesting is their market time is longer. Theirs is 62 days. That's because they have tenants in the home. It takes longer to get in and see those properties. What are we expecting this year for average market time? We are expecting market time to decrease slightly, either stay the same or decrease. Both are going to be right around the same amount. Why might we see a decrease? Well, we are seeing more sales off market. There is a whole marketplace that you might not be seeing on Zillow or other places. It is for a lot of top brokers have access to this. We can chat about that offline, but it is important to work with a broker who has access to these off-market properties. But since you have off-market properties, that is going to reduce market time naturally, because what happens is when it sells off market, I'm sure you've seen it. You find a home on Zillow, you love it, you favorite it, and by lunchtime it's sold, and you didn't even have a chance to even reach out to try to see it. It's sold in the off markets. So make sure you are in touch with a top broker to have access to the off market network, as that is very prevalent coming in this next year. It has been, but it's even going to be even more so prevalent. And so market time is going to be fast. So buyers, be prepared, have your pre-approval letter, because market time will go down, and the off market is very prevalent. Okay, so moving on from market time, we'll move on to average sales price. I like to report that we have had a steady increase in appreciation in Chicago. Again, this is attached and detached for all of Chicagoland, suburb, city. We have had a year over year 5.1% increase in appreciation. We have outpaced the country with this. In fact, other major marketplaces had a decline, including LA, San Fran, other cities in Florida had a decrease or single digit, like 1%, if that, appreciation, where we outpaced the country by 5.1%. So that is great news that we did have steady appreciation this last year. Same in the multi-units. So we, on the attached and detached, we were 5.1. The multi-units, I want to say we were 8.5. Let me get that number. Yes, 8.5. So multi-units have gone up as well. So what are we expecting for this next year? We are expecting that we will have a 4 to 5% appreciation in Chicago again. So year over year, Chicago has steady appreciation. It is a sound investment, and it has been for years. In fact, since COVID, in the last 5 years, we have had a 51% appreciation rate. Wow. I always like to say, Chicago is my slow and steady wins the race. We're going to gradually increase in value, but that means we don't have a steep incline, but we don't have a steep decline either. It is a steady, sound investment. It is also a cost-effective major metropolitan city. Honestly, you've got insurance is much lower in Chicago compared to some of these other major cities because they're coastal, they have hurricanes, whatever it may be. So keep that in mind as well. Something else to talk about in the appreciation is that rent. Rent has also gone up, and we've outpaced the country in that as well. Not something necessarily we're proud of, but I guess if you're an investor, you are. Rent has gone up 6.8%. Well, that is 7% over the national average. So keep that in mind. If you have been renting, that we are projecting rents to go up another 4 to 5% as well. Meanwhile, values have consistently increased as well. So in closing, I will share that we've had a good solid year where inventory came up about 3%. We're expecting it to come up another 3%. Average market time did come up, but we are expecting it to come down, and stay tuned to off-market opportunities. And then average sales price, we are projecting it to go up another 4 to 5%. So that is my quick snapshot of where we're coming from and where we're headed. So Mike, I'll let you talk about mortgage rates.
That was really great. I learned a lot from this. Some stuff I knew, but other stuff surprised me. So it was really good to hear the real estate perspective of it all.
Yes.
I'm Mike Vlamis from A&N Mortgage. A&N is a mid-sized company. We're in 23 states. We don't sponsor Major League Baseball, NASCAR, or college football, so we don't pass on high interest rates to our borrowers. Our rates are very competitive. Our fees are low. I happen to be at a time and place in my life that I'm available 24/7. Sometimes I'm not, but people appreciate it. So I'm available on the evenings, the weekends, and the holidays. Julie and I have had many conversations at 11:30 at night.
We have.
Taking care of problems.
And like New Year's Eve, but yes.
Yeah. So I just want to talk a little bit about mortgage rates, where they are today, where they're headed to this year, and what the determining factors are that make up residential mortgage interest rates. I was going to talk about appreciation, but Julie covered that, so I'm going to stay away from that. I am going to talk a little bit about condominiums, and you'll hear why later on, and multifamily properties, which Julie touched on too. I do a lot of research on a daily basis, and there's a lot of information from many sources. But tonight I've condensed it, and I'm trying to explain it in so let's dive in. So currently, the average 30-year fixed rate is around 6.2 to 6.4%. Contrary to popular belief, the rates are not going to plummet and crash and go back down to 3% anytime soon. Sometimes I wish they would. Those were good times for everyone. The rates now are hovering in the low to mid 6% range because of all the indicators that predict residential interest rates, such as inflation, 10-year Treasury yield, the Federal Reserve, employment, mortgage-backed securities, economic growth, global events, and the housing-specific factors. So you see there's a lot of things involved that make up where residential interest rates are. In the past month or so, they have dipped below 6%, but only for a very short period of time, and only for I think the longest they went under 6% was for 12 hours. So you got to be on your game. And if someone's looking and they're on hold and they want a sub 6% rate, you got to be there to lock it in for them, which we do. If you're looking to refinance or buy a new home in 2026, most of the projections are that the rates are going to settle out this year around 6%, close to where they are right now. So now's a good time to buy, especially before the spring market hits. Julie could attest to that more than me. If you wait till March or April, you're going to have multiple offers on the home you're going to drive the price up. January, February, as long as the rates are steady, is a good time to buy. A few of the experts predict that the rates may fall below 6%, but not till the end of the year. Others say they're going to be a little higher. I'm trying to believe in the sub 6%. So what can you expect? 6.1 to 6.4%, maybe the first 3-4 months this year. 6% to 6.3 in the middle of 2026. And then towards the end of the year, maybe 5.875, 5.9 to 6.2. We'll see a slight decrease at the end of the year. It's important we talk about one of those factors I mentioned that make up rates, and that's the Federal Reserve. Because when the Fed cuts rates, man, my phone rings off the hook. I get text messages and emails. Everybody says, Mike, the rates dropped. What's going on? Should I buy now? Should I refinance now? Well, the Federal Reserve rate cut is for short-term rates, or the federal fund rate. Mortgages are long-term loans. So the federal rate cut, it does slow market growth and lower inflation, but it's not the only factor involved. Think of the Fed as a weather forecast, not the actual temperature itself. I like that analogy.
Yeah, I like that.
The real backbone of residential interest rates is the 10-year Treasury yield. So since the average life of a mortgage is 7 to 10 years, investors price mortgages relative to treasuries of similar duration. So don't chase the perfect rate. If you're in the market or you're in the situation to refinance, to lower your monthly payment, or your family is decreasing or increasing, or you move out of state, second home, investment, take that into consideration instead of trying to catch the market for the perfect rate.
Yes.
Focus on your home and your long-term personal plans. My job isn't to quote today's rates, although I often do, but it's to watch the market daily, lock in when the timing's right, and help you understand all of your options without any pressure. But you don't track this. That's my job. So I look at the 10-year T-bill every single day. you might hear about a federal rate cut, but not see an immediate drop in mortgage rates because the market goes down weeks before the actual feds meet. They want to see if what the rumor is of the meeting is actually going to take place. So it goes down weeks before. That's kind of hard to comprehend because people, they say, Mike, I want to wait for the feds to meet. I go, you're too late. You need to act now. The rates are going down. I see it every day. So that's kind of important that you make a good decision today and not try to time the market perfectly. Two, I'm going to skip my appreciation section because Julie covered it very well. But I have two personal examples that I'd like to share with you. One is from a long time ago and the other is more recent. But many years ago when I bought my first condominium in a high-rise on Lakeshore Drive, the interest rates were around 12%. Now, I didn't know if that was high or low or in between. That's just what the rates were at the time. But I did know there was 18% rates prior to. So I bought the condo at 12%. I was happy as could be. And eventually I refinanced that condominium down to 9%. I really enjoyed the building, the view of the lake, the swimming pool, tennis court, the amenities. I didn't care if it was 9%. I liked the building so much, I bought a second condo in that building at 9%. Now you're thinking rates went down to 3% and they're 6% now. I had two condos in the city at 9%. Well, as time went on, both of those condos appreciated substantially, and I made a handsome profit on both of them. You know, I was young. I wanted to buy a condo on Lakeshore, and I just did it. And both of them worked out for the best. My second story is that someone very close to me was looking at a condominium several years ago when the rates were around 3%. They were looking at a $650,000 condo with 20% down and a rate around 3%. Now, being that that person was a first-time home buyer, they were a little scared to put down 20%, even though they had the money. So they waited. And wait, they did. And now they're looking at buying condominiums of a similar size, only they're $800,000 now.
Right.
So 20% down of $800,000 is more than 20% of $650,000 of equity on the table. That's a big difference. Fortunately, they paid high rents for several years and obtained zero equity in their apartment and accumulated no growth on their money. I wish my daughter would have listened to me.
Oh man, even your own daughter.
It was her. Yep.
I think we were helping her.
Yeah, Maggie's still looking for her right now. She's married now, and now they can afford more, so they can afford that $800,000. But she kicks herself all the time. I want to talk about a sensitive topic, and that's condominiums. You probably read of the collapse in the suburb of Miami of that 12-story high-rise in 2021. It was terrible, awful. 98 people perished in that
terrible
building collapse. So the guidelines for condominiums are much more strict now. They require an in-depth review focused on safety and structural integrity. Currently, there's 1,400 condo projects ineligible for regular financing nationwide. That creates obstacles for buyers and sellers alike. But having the right can be the difference. The difference between a stalled deal and a successful closing. There's 5 types of condo reviews: new construction, full review, 2 to 4 units, FHA single unit, and a VA loan for veterans. Each condominium project now has a questionnaire, and this questionnaire, condos and co-ops, by the way, it must be completed by an authorized representative of the HOA, the Homeowners Association Board. And critical repairs is one of the major problems with condos. That would include things that impact safety, soundness, structural integrity, or how the building as a whole impacts individual units. Routine, and they're not that serious as long as they can be repaired. Even with a special assessment, we can still finance those condominiums. projects are
Do you
ineligible.
mind if I
off the
chime
bat.
in?
No,
Do you mind
please
if I
do.
chime in for a second on that? Okay, because I just want to add that we have been seeing this a lot lately, that condos in the city are having issues with Fannie Mae, Freddie Mac approval. They're getting on the do not lend list just for, like Mike said, it could just be an easy roof repair. But if you mention a leak in your meeting minutes, all of a sudden it's non-warrantable because they are highly scrutinizing your condos. So one, if you own, keep an eye on your meeting minutes. Obviously, make sure you guys are being honest, but let's not over exaggerate a leak. Because if you guys, especially if you're being proactive about it, because how these meeting minutes are written is how the underwriter is qualifying this as unwarrantable or not. Once it's non-warrantable, that means Fannie Mae and Freddie Mac are not lending, and that's not a government-backed loan. So then you have to go portfolio. I'm going to chime in. Mike can do portfolio. So even if it's non-warrantable, it's not dead in the water. Still talk to us. We can help you through it. Your rate's going to be higher. I'm going to be honest. Your rate's going to be higher. You're going to probably do an ARM and then do fixed later. But know that this is a real thing that's happening, and we're seeing it all the time. Okay, sorry.
Bull for a real estate company and a pit bull for a mortgage lender, because as soon as we detect that problem, we don't throw our hands up in the air and quit.
Right.
We talk to attorneys, we talk to the homeowners association, we talk to the seller, we talk to both realtors, and we figure a solution.
Right.
It just happened to me on the north side of Chicago. It came back that the structural parking. Well, I called everybody and their brother, both agents, both attorneys. Eventually, I placed a call to the seller. I usually don't talk to the seller. I talk to the selling real estate agent. I called this seller and asked her if she knew anything about it. She said, yeah, I think I have an engineer study in my files that says it's okay. I said, wow. Produce it. She produced it. Pick up every rock and look for a solution. Very easily, I could have said, oh, they would have not got financing. But that seller had that document that proved that the parking garage was fixed.
Well, and most lenders out there don't even have, a portfolio option to where if it, if it ends up on that list, they're like, sorry, you're out. So it's good that you have options when you work with Mike. But know that this is an issue. It's a real issue that's going on if you're looking for a condo. I don't want condos to take over the whole talk, but.
Yeah. Right. We have our own condo department, so we kind of nip this at the bud. We have our own condo department, and we kind of nip it at the bud. We attack it right away when we find out there's a problem. We identify red flags early on, and you get personalized support from me and my condominium team. So there's fast answers, fewer delays, and a smoother path to closing. Lastly, I want to give you some quick facts on multifamily. In recent years, a few things have changed. Julie and I talked about this earlier. Unit property in investment, you've got to put 25% down. But recently, both Fannie Mae and Freddie Mac allow you to only put down 5% if you live in one of the units. That's a big deal.
Yeah.
5% on a 4 flat. You just live there for a year. And you rent yours out and go buy your other house, but you got 5%. It's great news that Fannie and Freddie are both doing that.
I agree. We call it house hacking.
Yeah. The last thing is that the conventional loan limit went up for 2026. It goes up every year. It's not that big a deal, but several years ago it was $350,000. Now, a single mortgage is greater than $819,000. You have to get a jumbo loan. Just a little tighter, a little more restrictions. We do them all the time, but the jumbo loan limit is $819,000 for a single family or a condo. For a 2-story, it's $1,048,268,000. And for a 4 flat, it's $1.5 million. So if you're over that amount, you have to get in the jumbo loan category and you can't go conventional. But look how high those numbers are.
And keep in mind that's mortgage amount. So, and your mortgage is 80%, 90% of what the full purchase price is. So I was just doing the math. If it's 817 is the new limit, so then that would be a purchase price of 980. Am I doing that right? I added 20%. If you put 20% down, yeah.
So you can still buy almost $1 million home and get a conventional mortgage.
Exactly. So your rates are usually lower with conventional, right? So
okay, I hope that helped a little bit.
Yeah, that's great. I love it. All right. Well, thank you, Mike. And Marcy, show us all the design fun stuff.
All right. Well, you have to tell me if you're seeing everything since I
now you're going to share the toys. Yes. Yes, we can see.
I can see
design tips. I love it.
Okay, and that's big enough because actually I'm doing the dual screen thing so I can see both.
Oh yeah, I can see it.
All right, cool. So I'm going to talk about kind of all these tips twofold. So partially, Julie outlined low inventory when you're looking to buy, and that likely leads to whatever home you're buying not being perfect for you. So what things you can keep in the back of your mind when you're looking for a home to buy that might be easy changes, low investment changes that will make that home feel like yours so that you don't feel like there's nothing out there for you. And then on the flip side of that, things that you can do to make your house or condo more ready for selling. So I'm going to kind of talk about both of those sides within kind of what I've outlined here.
Amazing.
So we're going to talk about paint. We're going to talk about hardware, kind of cohesion. That's my most designy. Well, I guess cohesion and add the unexpected are pretty designy, but art and then adding the unexpected to your home. So paint. I mean, I think we kind of all know that it's one of the easiest, most affordable, big impact changes you can make in your home, whether you are moving into a new place and want to make it your own, or if you want to clean up the look of your home and get it ready to sell. One of the most useful recent tools that I've started using and lots of people have is AI. So if you've got listing photos, which actually this right here is a listing photo, I have no affiliation with this property at all, but I literally just did a screen grab and then popped it into ChatGPT. This is actually a different one. And you put in the photo, the listing photo, you tell it to change color of the walls. I like to add a swatch because I think it gives it a little bit more information to go on. And you can see the impact of color. So whether or not you're, listing or trying to feel what it would be like to buy a place and sort of make it your own a little bit, it's a really, really great tool to do that, to be able to visualize those things. And if you're, this is kind of another fun AI thing that I did just to play around with. Truly, paint and wallpaper can completely change a space. So when you're looking at a house and it doesn't have any personality and it doesn't feel special, just keep in mind that non-structural changes like paint and wallpaper can really change a space. So don't get discouraged if everything feels kind of personalityless and just like drywall boxes. You really can affect big change with small investments.
Yeah.
So the next one that I want to talk about is hardware. And this is one that I think doesn't always get enough credit. Doorknobs. That's kind of been my new soapbox because you touch them all day, every day. You touch your faucets all day, every day, and you touch your doorknobs. And if those feel cheap, it gives the overall impression of builder grade or that somebody chinsed out.
You're right.
So invest in nicer hardware. Now, that doesn't mean you have to spend $80 on every doorknob. There are wonderful companies out there. Schlage makes great options. There are a lot of great options. So pay attention to your doorknobs. It's also something that you can change when you move in, low degree of investment, and it can completely change the look of your doors. Hardware doesn't stop at your room doors. Cabinets and drawer pulls, also one of those things you touch and feel every day. It's something that you can easily swap that can give a bathroom or a kitchen more personality and make it a little bit more your own. It's also something you can take with you. If you are home hacking, like, Mike and Julie said, and you are only going to live in a place for a year, you can invest in some really cool hardware. And then when you move out, you put a less expensive, less special piece in, and you take the expensive hardware with you, which is also, I think it makes it easier to spend a little more money if you know that you can, it can come with. And then two other types of hardware that I think also get overlooked are switch plates and outlet covers, and also things like rope hooks and towel bars. Those can overall give either a more premium look or a less premium look. And when listing, I don't know if this is a pet peeve of Julie's, but it was one of the things that I always looked at: broken switch plates and outlet covers. It's such an easy fix to just go to Home Depot and replace those. You get a 3-pack for $4. It just kind of, the overall impression of your home, each thing kind of adds to that overall impression. And if you have buyers come in and see cracked switch plates that you could have switched out for $3, it could give them a less ideal impression of the home you're trying to sell. Okay. So, and whether or not that is accurate, it still is what they walk away with. So next is cohesion, and this is more on this house doesn't have any personality and I want to make it my home, but I'm really overwhelmed by that task. You can hire a designer. That's also super helpful. But one of the tried and true tips that I give people are, it's sort of like an advanced mood board. You delineate things, whether it's a color palette. Okay, these are the 4 colors that I want to be my guidepost. Or I want to mix brushed brass with polished nickel. So you have those two metal finishes. So you don't deviate from those, and those pop up in each room. And then you can have materials, whether it is a wool fabric or a marble. And as long as you pick up a couple of those guidepost pieces and you implement them in every room, even if other things deviate, you will still have an overall cohesion in your home because you repeat those elements. And that's kind of the easiest tried and true way to go about that. You need to, before you start the process, you put everything that you're selecting through that filter. And that's how you kind of end up with a home that makes sense.
I'm going to interject 2 seconds here, just because you did that for my house. You laid everything out, and there's something about laying it out and seeing the cohesion. It puts it all together. So I think that's smart too, to like literally physically lay it out too.
Mm-hmm. I mean, visuals are huge. Getting samples, if you are working with a designer, your designer can order samples, but most off the rack companies, you can order samples in fabric swatches from everywhere. And I highly suggest getting your hands on physical samples. There's also a great company called Sample-Eyes. So you can do real paint swatches. They're about an 8.5 by 11, and they actually stick on the wall. And it's a great way to help pick paint because you can view it different times during the day and in different rooms because it peels and sticks, and you don't have to get a paintbrush out, which is fabulous.
That is great. If you're thinking of selling, that's the perfect thing to do. Get the Sample-Eyes, we throw it on. Okay, let's do the cabinets in this color. Let's do the walls in this. We've done it a lot for us.
And the great thing about Sample-Eyes is they actually have some packages. So they'll have like a warm white package, and they send you 8 different warm whites. So you don't have to go through and pick them separately. You can just say, okay, I want a grayish and I want a white, and you order those packages, and that thinking is kind of just done for you, which is really nice.
Love that.
So next thing, this is a little bit more on the I'm a buyer and this is boring. What do I do? People forget about art. And it was one of the things when I was first getting started as a designer that I would get frustrated because the clients, I would get them to a certain point and then they wanted to not invest in art, or they had decision fatigue. And so they wanted to leave the art for later. Try not to do that. And you don't have to invest hugely. But art truly does make a huge difference in your home.
It does.
And so some tips to make it a little bit more interesting, having a piece that's slightly undersized or a piece that's slightly oversized. It creates tension in the room, kind of this middle piece. Technically, that piece of art is oversized for the space, but it makes for a really dynamic space because it creates that tension. Hanging something a little off center. You know, they have this piece of art above the tub. If it were in the center and these weren't here, that would be boring. Yeah. But this again kind of creates that tension, and so it makes it a little bit more interesting. And you know, it's a beautiful bathroom. There's not a whole lot going on. The art truly does take a much more basic space and make it interesting. Another thing you can do, this is actually a larger frame with a print with 2 smaller frames in it. So taking, you know, off the rack prints that you find or family photos and framing them in an interesting way, or putting fabric on a mat board, those types of things can really add interest, which, you know, for some Mod Podge and some scrap fabric, you know, you can get something really interesting, and it's a small investment.
Love that.
So add the unexpected. This again is a little bit more, you're a buyer and, you know, looking to make things interesting. My goal is, if I'm designing my own home or if I'm designing somebody else's home, is for guests to say, that's not for me, but that's really cool about at least a couple things, because your home should never be applicable to everybody else, because it's just yours, and it really should just speak about you and to you. It should bring you joy specifically. And so I try to guide my clients to not be afraid of things that are a little off center, or a little, you know, something that they haven't seen on Instagram or Pinterest a million times, because those homes aren't theirs. And so don't be afraid of the things that are a little odd or a little quirky. If they bring you joy and you find them interesting, they will work in your home. And it's okay if it's not for everybody else, because nobody else lives there. It's yours. So that's my quick spiel about designing and thinking about design when you're shopping, or you know, those little tips and tricks when you're getting ready to list.
Amazing. And now we've got the chat open, or Q&A, if you want to send us some questions. We did get some along the way. Mike, first one is for you. Regarding the Fannie Mae Freddie Mac multi-unit loans, the 5% down, does it also require PMI?
You cut out on, but I think it was a question about PMI.
Yeah, on the 5%
Julie?
down for the multi-unit. Yep. Do you require PMI on that? Okay.
Yes.
Okay.
Anytime
it's below 20%, it's the PMI, right?
You hear me? 20%, you have to pay PMI. That's correct. Okay. Now, sometimes on the jumbo loans, because it's a jumbo loan, I might be able to find an investor that will waive the PMI. But in general, anytime you're below 20%, including 5% on a 2, 3, or 4 flat, you have to pay PMI.
Okay, perfect. Question for Marcy. What pre-listing improvements or staging trends are returning that offer a good ROI?
You for sure will have some thoughts there?
Well, I agree. I think you and I are on the exact same page. I think it's simple things. I think it's making the home look complete. So, like you said, simple things like the outlet not being, chipped, the light switch same, and paint. My team knows this. A lot of my clients, I know some of you are on here because we were talking about paint earlier today. Paint is a big thing for me. And we've got Uncle Chuck who paints, who's very inexpensive. I know Marcy, you've got a great painter too. So call us because we've got great painters. But paint can absolutely, let's say, I'm going to be honest. A lot of people think, the white kitchens are still in. White is not necessarily in. And so you may want to spend the money and actually paint it like a green in your kitchen. And I've had some clients take my advice on that and we've had a big return. So paint and just making sure the home is complete. Simple things, caulking, making sure the trim is not damaged, making sure the fixtures aren't damaged.
I'll second caulk. You don't want, and this is even like at your baseboards, where your countertops meet your walls, where your tiles meet, terminate, hire a handyman or have Julie help you source a handyman, make a list. We like to call it a punch list of all of the things that are just a little bit of an eyesore. And Julie and her team are so helpful because we do get blind to our own homes. We've seen the things a million times. And so we truly just don't even see them anymore.
Right.
So caulk is a really big one. Having all of your light bulbs working and all the same temperature. And it might be a pain in the butt, but if you have a 3000 Kelvin temperature light bulb and next to a 2700, it gets really disjointed and it's not a pleasant experience. So light bulbs all working, all the same temperature, caulk, paint. Like if you've got a painted handrail, make sure that it's either repainted or you take a magic eraser. But Julie and her team are really good at coming in and seeing the things that you've stopped seeing. But yeah, just if anything is broken and easy enough to fix it, just go ahead and fix it, because that will give them the overall impression that your house is really well maintained and that it's been kept up really well.
Agreed. And lighting can be cheap too. I know you've had, and a big difference. You and I have worked with like West Elm lighting. We've worked with IKEA lighting before. Yeah. So lighting can be a big one. If we feel like, okay, we're not redoing the kitchen because that's going to cost us a lot, but let's add this really unique light fixture that didn't cost us a lot and it made the kitchen feel different. So
and just brighter. If you walk into a room and your buyer says, oh, it's a dark room, if you added an extra light, whether it's a plug-in sconce, I've actually got one right here, no wiring. Is it my favorite? I mean, it's fine, but it serves a very real purpose. And so lighting is huge.
Yeah. Agreed. Okay, this is on Southwest Suburbs. So for those of you that don't know, Busby Group launched a Southwest Suburb division. We have a whole division dedicated to the Southwest Suburbs. So we do have a very specific question here. And Mike, I know you're from that area. My family's from the area. A lot of our team is from the area, so that it made sense for us to help everyone out in that area. The question is, what properties are moving fastest in the Southwest Burbs? And my question is, yes, they're all moving fast in the Southwest Burbs. So if you're buying, please make sure you're working with us because we know of some things off market. You're not going to have as much off market in the Southwest Burbs. I'll be honest, it's not a full 20%, but it's probably 5% we know of off market. And things are selling fast in the Southwest Burbs. So just know that and be prepared and work with us. If you need to sell and buy, we can help you navigate that as well. But things are moving quickly there. Okay. Yes.
Julie, you probably don't know this, but when you said earlier that one of the lowest days on the market was 37 days in Palos Park.
Yes.
That's my hometown.
I
heard that loud and clear.
Yeah, it's a hot area. It's a hot area.
Wow.
Okay, so next question. When is a good time to sell or buy this year? when do you need to sell or buy? And we will make it happen for you. But if we want to know market data, historically, spring market is our busiest season, meaning that's going to be when you're going to have the most inventory as a buyer to look. That's also likely when you're going to have the most interest in buying your home, and likely selling up to 10% more in spring market. Spring market is not when the birds are chirping and the snow is melted. Spring market, quite honestly, has already started, unfortunately, because we are so low on inventory at the moment. We haven't had that increase yet. I think what's going to happen is we're going to have the increase in inventory and the buyer, and it's going to miss our heavy demand season. So when is a good time to sell or buy this year? One, it depends on what's going on in your life. So that's where we always start, is what's going on in your life. And then two, we can navigate that for you. But I can give you data that spring market is when you're going to see the most inventory. As a seller, that's also likely when your home's going to sell for the most. If you're looking for, buyers are always saying, I want to steal. You're not necessarily going to get a steal, but you might get an opportunity if you're open to buying something that needs work. And now you have Marcy who can help you. And if you buy a little bit in the off season is right after spring market, right around Memorial Day through Labor Day. It's slow. Then we have a pickup again in fall market, and then it's slow at Q4. So as a seller, you don't want to sell in Q4. That's usually the slowest time. Historically, you'll get a lower price during that time. And not to say that Busby Group hasn't sold at a high price at that time, because we have, but historically, Q4, you don't want to sell in Q4 unless you have to. Okay, next question from Chad. Can we rely? This is talking about AI, because Marcy, you touched on AI. AI is hot, of course. AI is now incorporated in our life. So with AI, is Zillow and these other online forums accurate with our pricing? Because now AI is getting better. I can tell you, I have firsthand heard the economist at Zillow said that their numbers are off by at least 5%. Also, Zillow or these other online algorithms do not see the home in person. So they don't know your finishes. They don't know there's a tenant in property. They don't know all the details. The algorithm is also not taking into consideration the train tracks that are right there, or the great school. They also don't keep that in consideration either. So no, do not rely on the algorithms. Great baseline to maybe kind of compare to, but I've seen it off as much as 10%, but I've heard their own economists say it's off by 5%. So, and that's a big swing. If we can get you 5% more, I'm sure you would appreciate that. Okay. If you have a home to sell and one to buy, what are the best next steps? So that's actually something that we help with a lot. I want to say 80% of Busby Group clients have to sell and buy. So it is, we can absolutely help you navigate. And what we are finding is, in this busy marketplace, a home sale contingency will not get accepted. And Mike, I know you see it too. A home sale contingency will not get accepted. So what we are finding is that's when the off markets are going to be the best option for you, and an outstanding option. We'll do a lot of off market marketing, and we can sell your home in the off market networks. And if you sell during the busy season, which is usually spring market, sometimes fall market, we can get you amazing terms where you can lease back or live in the home longer, and then use that time to buy your next home. So you then already have cash in hand to go buy the next home. So we're not doing a home sale contingency. You've already sold your home. We helped you navigate that, got the home ready with Marcy. Everything's ready. We priced it well. And I say off markets just because we'll likely market that we need 6 months of occupancy. And I don't necessarily like putting that out into the open marketplace because that might limit your target audience. We've had incredible success with this. In fact, I think we have 3 to 4 clients under contract right now that this has happened with. We've sold their home off market in advance, and now they've been living in their home for free. We have one that sold last October and they're living in the home till June. Just saying. So they're, and know that, and then now they've already found their new home. But now they get to they're fixing up the new home. And so now they have more time to live in this home. So anyways, no, we can help you navigate, getting you top dollar. So there's many ways. And Mike, I would also say, make sure you speak to a lender right away to find out, get your pre-approval. Because sometimes you think that you have to sell to buy and maybe you don't, and maybe you don't need that home sale contingency. So it's important to chat with a lender as well.
And when I find out that you are contingent upon selling your current home, then I bring up things like, can we get a cosigner? Or can we get a gift for the down payment and closing costs?
Right.
Or can we look at down payment assistance programs? Sometimes that debt to income, which should be under 50%, is just slightly above 50%. So a larger down payment or a cosigner can bring it down and you can get pre-approved non-contingent.
Great.
So I'm going to pipe in with my own anecdote about working with Julie and needing to sell your current place and buy a new place. That was me working with Busby Group in summer of 2020. And we didn't do an off-market sale, but we had, if you were not aware, summer of 2020 was bananas. It was the wild, wild west of trying to buy a home.
Yes.
I had a recent 3-year-old and an 8-month-old.
Yeah.
And we needed a bigger home. So we had gotten outbid on several places, and Julie was like, we need to pull your home sale contingency. That's, really the only way to be competitive. She and her team walked me through the process so that we could get comfortable, and we were able to get in the place that we're in now. And to the point of her walking us through the process, it was COVID, couldn't have babysitters, all that. I had 2 small kids. I was planning on cleaning the house that we were selling the day that we were selling it. And we were closing on both the same day, hours apart. And I said, Julie, I'm losing my mind. I cannot finish cleaning the house. She had cleaning ladies in my house to clean prior to closing. I mean, it was just done. I cannot express that I could not have done that process without her and her team. And she found us the perfect home. And we've been here for 6 years now and still love it. And it can be done. And it's really important to have the right partner. And she certainly was for us.
And that's the thing. Like we can walk you through it. There is a little bit of a leap of faith, but we will not give you bad advice. If we feel you can sell quickly, we are going to make that happen for you. So in that scenario, we had already made the offer, got accepted, and then we had to sell quickly. And I said, I can do it, Marcy. Give me 2 weekends.
Yeah,
and we did it.
It was true. And we closed. I mean, truly, we closed on the sale of our condo. I literally took a physical check, and drove it to the closing of our new condo, and it was seamless. I mean, it all happened in the same day, and it was great.
That's great. I love that. Okay, we have a rate question. Mike, what is the difference in rates on condos versus homes?
Great question. Condominiums are always higher because there's a little more risk involved. You're not just financing your individual unit, but you're relying on the whole structure and building to be solid, like some of the examples I mentioned.
Right.
Condominium rates are higher than single family home rates, just like a second home is higher than a primary residence, and an investment property is higher than a second home. That's a good question, because
that is good.
Sometimes 2 family members buy a house, one buys a condo, one buys a house, and the condo people are saying, hey, Mike, why is my rate higher than my sister's or my brother's?
Right.
I have to explain, because it's a condominium.
That makes sense. Okay, we have 2 more questions. So we're basically wrapping up. So you mentioned off-market marketplace on the forum. Tell us more about that. Is it good for buyers to consider using the off-market networks? Yes. So there are many off-market forums. Busby Group is housed at Compass. Compass has Compass coming soon. private exclusive. Those are two forms that are off market. Plus, Busby Group has access to the top agent network, which is only for the top 10% of brokers, where we share properties before they go on the market to get a frenzy about a home, or maybe the seller needs to stay in the home through June because of their children's school. There's all sorts of reasons why there's an off market. And that's why the off market has been very favorable to a lot of people. So off market is important. When you work with us, we actually set you up on obviously the live marketplace searches, but we also set you up on all the off market networks, which is about 4 or 5 of them. Plus at Busby Group, we have excellent relationships with brokers around Chicagoland and in the suburbs, in the city. And they'll send us listings before they go on the market. That just happened today. Someone calling and saying, we have something coming. We know Busby Group does a lot. Do you have a buyer? And we did. So absolutely, off-market forum is very important. So don't just be on an island looking on Zillow, because you're missing, in the suburbs, you're missing 5 to 10% of the marketplace. In the city, you're missing 20% of the marketplace. Okay, final question. We're trying to sell our home. Falling lower interest rates mean that sellers can get a higher sale price because of higher demand? Is that what we're going to see this year? If so, when is the best time to capitalize on that? No. And let me explain why. Well, it's not a blanket no, but I'll tell you, because Mike, you mentioned rates are basically sticking around 6.1, 6.2 the majority of the year until Q4. And then in Q4, it's like, and that's what happens every year. We had that happen this year. The rates went down in Q4. In Q4, properties, there's not as much demand, and there's not, and the inventory that is there, buyers assume that you're having to sell, and so they're trying to get a good deal. So I don't recommend following the rates because you'll miss the market. Mike and I always say this: don't try to time the market because you'll miss the market. So I would, rates historically tend to go down at the Q4, and Q4 is also when the market is historically a slower time to sell. So I would not wait for the rates. I hope that helps answer that question. Okay. Any closing statements? Marcy, I know you've had, this last year was a fun year because you helped 2 Busby Group clients do major remodels, and I think their appreciation, let's just say what they invested, they at least are getting 3 times back what they invested by what Marcy did. So that's fun. Any fun tips, I guess, that you learned from those 2 fun experiences from the year?
Well, one of the great things about Julie and I being such good friends and having been each other's clients is that I'm able to go to her and say, hey, this client is thinking about doing X, Y, or Z. What do you think is the best place to put their money? What are you seeing in the market on ROI on, kitchen renovations versus a primary bathroom renovation? And so I think that's really important.
Agreed.
But I think one of the most fun things is that while these clients have been, investment minded, people are willing to do, moments of interesting things, moments of things that are a little, that might not be for everybody, but because that's one of the benefits of actually having low inventory. It does give you a little bit more latitude to do the thing that might not appeal to everybody because, there's not a huge, inventory out there. And so if somebody's going to not buy a house when there aren't that many houses because of a backsplash, that's kind of silly. So, but I always do kind of, we'll have some gut checks with Julie if we're making really big moves and what she thinks, moving a kitchen from the middle of the house to the back of the house versus adding a bathroom on a 3rd floor, which is a real conversation that we had with a client. And I think that we all wound up in a really good place. And I think the client is going to get really good results.
Agreed. That is fun. So we get all get brought into an ROI conversation of, hey, we have a design meeting. Here's what we've picked out. What do you think? And I do honestly say, maybe don't do the red, refrigerator, but no, that usually doesn't happen. But we did, and we actually helped. We came up with another idea for them as well, that they hadn't even thought of, that to help with improved value. So anyways, that is fun to work together. And then Mike, are we bullish about this year? What are we thinking? Are we excited about this year with rates and what to expect?
Yeah, you know how optimistic I am. And contrary to everything I told you, those are the quote unquote experts. But like you said, your business goes down a little in the wintertime, and so do the rates, because there's no business. They're
Right.
trying to entice business, try to make it happen out of nowhere.
Exactly.
I personally think there's going to be a change coming up soon with the chairman of the Fed. And I think that the rates might go down sooner and more than everything I said. That's just my personal opinion.
I love that. That's good little insider information for those who stayed on the whole time.
Yeah,
Lucky you.
And I got a lot of people at 7%, and they don't want to refinance at 6 innings. So I'm hoping for 5.75. If we get the 5.5, it's going to be a refi frenzy, a refi boom.
Right.
So I'm hoping sub 6% sooner than the experts are predicting.
Right. But I also feel buyers have come to embrace and understand 6 is where it's at, and it's okay. I think everyone's feeling comfortable about that. I've been doing this 25 years. Do you know that the average rate since I've been practicing is 7%? So that, I know. So it's funny that we're even talking about this, because the average, and I've had a very successful career and clients make a lot of money, and it was 7% is the average rate. So 6, even if you're in the 6s, you're fine. But don't chase the rate, because you can't time it. And if you try to time it, you'll miss it. And we'd hate for you to miss it. And we're here to be your advocates. So in closing, Chicago is an excellent place to invest. It's there are so many pros, and we're happy we had a good year. We're outpacing the country in appreciation. And you've got a panel of experts here to help support you and be your team. So just let us know how we can help. If you have another topic that you want to talk about, or you have further questions, feel free to reach out. But we wish you all a wonderful evening, a glass of wine, whatever you want to have a good nightcap tonight. But we appreciate you tuning in, and wishing everyone a wonderful year. Talk soon.
Thanks, Julie. Thanks, Marcy.
Thank you.
Bye,
Good to see you guys.
Bye.